Welcome, and thank you for joining this presentation on FedEx and the Freight spinoff, a strategic analysis and recommendations. Today, we will explore the key factors that lead to FedEx's decision to separate its freight operations, examine the strategic implications of the spinoff, and evaluate how this move positions the company for future competitiveness. We'll begin by outlining the background of FedEx's business model and the challenges within the freight segment. Then, we will analyze the spin-off decision using strategic frameworks and conclude with actionable recommendations to strengthen FedEx's long-term market position.
In this case study, we're going to take a look at the FedEx background, their corporate strategy. We'll look at a high-level overview of FedEx Freight, the strategic issue statement, a spin-off rationale, external environment, Porter's five forces. We'll do an internal value chain analysis, a resource-based review. We'll look at a corporate strategy fit assessment, portfolio management, strategic differences, organizational design issues, pros and cons of the spinoff, a SWOT analysis, and then we'll end with the strategic recommendation and expected outcomes. FedEx is a global leader in the logistics industry, operating a diverse portfolio that includes transportation, e-commerce, and business services operating in over 220 countries. The company was founded in 1971 by Frederick W. Smith, and formal operations began in 1973 when the business was moved from Little Rock, Arkansas to Memphis International Airport. Their initial public offering, or IPO, was in 1978 on the New York Stock Exchange, and share price was listed at $24. FedEx quickly became known for its overnight and express shipping, which was a huge innovation at the time compared to the traditional mail or freight services. And by 1983, the company had reached $1 billion in revenue. International operations began in the 1980s in Europe and Asia, and then in 1994, Federal Express was officially rebranded as FedEx, and then again in 2024 transitioned back to FedEx Corporation. FedEx has core business services and divisions. It has the Express division, which is a time-sensitive overnight and international shipping segment. This generates about 50% of the overall company revenue. There's the Ground segment, which is a cost-efficient ground parcel delivery for domestic customers. This represents about 30% of the company's revenue. It has a Freight segment, which is its less than truckload or LTL freight shipping, which generates about 10% of the overall revenue. And then it also has other services like FedEx Office and supply chain and e-commerce and technology solutions, which is also known as DataWorks, that also contribute about 10% to the company's revenue. The current risks and challenges for FedEx is that it has strong competitors in the market like UPS, DHL, and other regional providers. Fuel prices, labor strikes, and economic slowdowns affect the company's bottom line, as well as e-commerce trends can increase volumes but also add additional pressure for delivery SLAs and also cost on small revenue packages. The company's financial performance in their fiscal year, which runs from June to May. In FY25, their total revenue was just under $88 billion. And then in the first quarter of FY26, which is June, July, and August of 2025, they had adjusted revenue of $22.2 billion, an operating income of $1.3 billion, and a diluted earnings per share of $3.83. So FedEx's corporate strategy, so they have a logistics portfolio. FedEx operates a diversified set of transportation and logistics businesses. It has ground, express, freight, logistics, and office, which has its retail locations. These businesses together serve as an end-to-end supply chain provider for its customers. They're also focusing on their global scale and network strength because FedEx is available and serving over 220 countries. It has one of the world's largest logistic networks. FedEx is also working as of June 2024 to combined its operating companies. So historically, each segment of the business had operated independently, but as of June of 2024, FedEx has taken on a One FedEx initiative, which is intended to have a unified structure. So express, ground, and service segments are all combined into a single entity under the Federal Express Corporation name. They have an integrated network. This is one of the core changes of this initiative in that historically each operating segment has had its own internal network. This should allow for enhancements with flexible shipping, merging operations, and facility optimizations by integrating those historically separate networks into one. By consolidating these networks, this initiative is intended to have huge cost savings. It's intended to generate billions in cost reductions by eliminating the overlapping operational layers and improve asset utilization across the company. And then it should also provide a simplified customer experience because it will present a single integrated platform to its customers, making it easier for them to use FedEx's broad portfolio services. And then also a current corporate strategy, and the focus of this presentation today is their portfolio optimization, where FedEx plans to spin off FedEx Freight, its LTL segment, to create a more focused business and unlock shareholder value for both FedEx and FedEx Freight. So, FedEx Freight overview. FedEx Freight is a less than truckload LTL segment of FedEx that specializes in shipping consolidated shippers' freight loads in a single truck. So, it offers a variety of LTL services that include regional and long haul to support a variety of customer needs, which would be speed versus cost. It delivers to nearly every U.S. zip code, giving it extensive coverage and reach. And the pricing of shipments depends on the weight, dimensions, freight class, origin, destination, and surcharges. And it operates on a typical hub and spoke model. For financial performance in FY24, this business segment generated $9.4 billion in revenue and claims to be the largest LTL carrier with the broadest network and fastest transit times. Quarter 3 of FY25, freight revenue did drop about 5%, and this is driven by lower shipment volumes and yield declines. Operating income also declined by roughly 23% in the same quarter. However, expenses did fall, and those areas included fuel and salaries. So, what is the strategic issue statement in the spinoff of FedEx Freight? Well, today, FedEx is managing two fundamentally different business models. They have a global parcel with ground and express delivery, and then a less than truckload freight delivery segment. These are all today operating under one umbrella, and each of these segments, the ground and express, the parcel part, and then the LTL part, each have distinct market dynamics, capital needs, operating models, customer bases, and growth trajectories. The one size fits all structure restricts the ability for each one of those operating segments to really find and fine tune its specific market requirements. The LTL business segment may be undervalued by investors related to its standalone LTL peers. And then capital allocation, strategic planning, operational focus are spread across different business models that reduce the agility and cause each segment to miss its operational potential. Based on these issues, continuing to operate FedEx Freight as part of the broad-based delivery company prevents both FedEx and FedEx Freight from maximizing their full potential. So, for the rationale of the spinoff, it is thought that it will enhance operational focus and strategic execution. By separating freight into its own company, it will allow each of the business segments to focus and concentrate on their core strengths and allow for a more nimbler approach to their changing market dynamics. It will potentially unlock shareholder value. Freight has historically been a high performing segment with consistently strong profitability and growth. However, it's bundled inside the larger corporation and hasn't been fully recognized. Once Freight is a standalone company, it's likely to command a valuation much more comparable to its pure LTL peers. It'll have a more tailored capital allocation and investment strategy. Being a separate company, each company can deploy capital, make investments, and set priorities that are best aligned with their individual operational needs. And then they'll be able to preserve key synergies with allowing independence. So after the spinoff, commercial and operational collaborations between the two companies will continue where beneficial. This allows the best of both worlds. Freight becomes independent and focused, but doesn't lose all connection to the FedEx broader network. And then finally, to align with market and industry dynamics. Logistics and LTL freight markets have different demand cycles, cost pressures, and growth drivers compared to parcel and express shipment.
My name is Jasmine Harris, and I will be speaking about the external environment of pestle analysis as it relates to external forces influencing FedEx Freight spinoff decision. This slide applies the pestle framework from Chapter 2 to analyze the external pressures shaping FedEx Freight's environment. Politically, the LTL industry faces strict DOT and FMCSA regulations that increase operating and compliance costs. Economically, slower industrial activity and rising fuel and labor expenses have reduced freight demand. Social trends such as e-commerce growth favor parcel shipping more than palletized freight. The pestle analysis continue as it relates to the external forces influencing FedEx Freight spinoff decision. Technologically, freight requires different systems and has less automation compared to FedEx's parcel network. Environmental regulations also require costly fleet upgrades, and legally, the trucking sector faces higher liability and safety requirements. Overall, these pestle factors show that FedEx Freight operates in a more demanding environment than the parcel side of the business, helping explain why separation is being considered. We'll talk about Porter 5 forces, LTL industry, which means less than truckload. This slide uses the Porter's 5 forces to show why the LTL industry is highly competitive. The threat of new entrants is low because LTL requires major investments and strict regulatory compliance. Buyer power is high as large shippers often negotiate aggressively and can easily switch carriers based on price or service. Supplier power is also considerable, driven by persistent driver shortages, volatile fuel costs, and the expense of equipment and maintenance. Substitutes like truckload, parcel, and intermodal create additional pressure. Rivalry among LTL carriers is especially strong, with companies competing heavily on both price and service offerings. Together, these forces show that LTL operates under a tougher competitive structure than FedEx parcel business, helping explain why FedEx Freight may not fit as well within the broader company. We'll talk about the internal value chain analysis as it relates to the internal value chain comparison to parcel versus LTL freight. This slide compares FedEx's parcel network with its freight operations using the value chain model. Parcel relies on automated sorting hubs and high volume delivery routes, while freight depends on freight terminals, pallet handling, and more manual labor. Beyond operations, the two divisions also differ in customer bases, pricing structures, and service expectations. Because their logistics systems and operations are so different, the two divisions share very little synergy. This lack of internal alignment reinforces the rationale for considering a separation of freight from FedEx core parcel operations. We'll be talking about the resource-based view, which is VRIN assessment as it relates to FedEx Freight versus FedEx corporate strengths. Using the VRIN framework from Chapter 4, this slide highlights the FedEx strongest resources: brand, technology, global, network, and integrated air-ground systems, primarily supports parcel and express business. These advantages are less relevant in the LTL industry, where FedEx Freight competes with many similar carriers. Freight also does not use the resources that competitors would find difficult or costly to imitate, such as FedEx Worldwide Delivery Network. As a result, Freight gains fewer benefits from being part of a larger corporation, suggesting it may operate more effectively as a separate business.
FedEx's corporate strategy is primarily related diversification. They operate across courier, freight, logistics, e-commerce, and business services, which are all tightly connected to transportation and supply chain management. FedEx also has specialized areas such as healthcare and automotive logistics, which are extensions of the core delivery model and not an unrelated venture. They have also made strategic acquisitions by aiming to strengthen their geographic reach within logistics. One example of this is TNT Express in Europe. FedEx, however, does not branch out significantly into industries outside of logistics and services related to that. They do have supportive services such as billing, IT, and communications, but they are not considered unrelated or standalone businesses within the company. FedEx also achieves strong economies of scope by reusing assets, technology, and brand equity across related services. Under shared infrastructure, they leverage their global transportation network across multiple service lines, which reduces unit costs. Platforms like FedEx Surround provide real-time visibility across healthcare and automotive shipments. This spreads R&D costs across industries and assists in technology integration. FedEx also has a single trusted brand that supports multiple offerings, which helps to lower marketing costs. Businesses using FedEx for parcel delivery are often adopting freight and other offerings that support cross-selling. For operational synergies, FedEx has integrated air and ground networks that allow FedEx to optimize routing and capacity utilization. In addition, FedEx provides strategic leadership and consolidated financial reporting that ensures capital allocation across its entire portfolio. FedEx has also been expanding into healthcare and automotive logistics, as mentioned previously. This aligns with their push towards higher margin and time-sensitive shipments that strengthen their competitive positioning. They also have e-commerce partnerships that tie directly into their logistics segment. For FedEx's portfolio positioning, the less than truckload, or LTL, freight market is mature, cyclical, and heavily competitive. However, this growth is slower when compared to e-commerce driven parcel delivery and global logistics. In addition, freight revenues are stable but lack the high upside of international express or digital logistics. They also have a moderate level of attractiveness. Freight provides steady cash flow and strong market share in LTL. However, industry fragmentation, pricing pressure, and exposure to economic cycles limits long-term strategic appeal. In terms of rationale for a divestiture, FedEx is able to unlock shareholder value by spinning off freight and creating two focused companies. This allows investors to value each entity independently. They also focus on higher growth segments like parcel delivery, e-commerce logistics, and global supply chain solutions, while freight can pursue their own strategies as a standalone. The freight industry is also facing demand uncertainty due to a potential recession. This makes the separation a way to protect the core business from possible volatility. Moving on to strategic implications for FedEx Corporation, they have a streamlined portfolio focused on high growth and attractive businesses with improved capital allocation towards specifically technology, automation, and international expansion. On the other hand, the strategic implications for FedEx Freight show greater autonomy to optimize operations in the LTL market and the ability to tailor pricing, investments, and growth strategies without competing for resources with FedEx's parcel divisions. For parcel, FedEx's core focus includes small packages under 150 pounds that are serving consumers and businesses. They have a few competitive drivers such as speed and reliability, which include overnight and 2-day delivery with a global reach. Technology integrations that provide advanced tracking, e-commerce fulfillment, and last mile optimization, as well as customer expectations which are driven by Amazon and other carriers that require flexibility and innovation. In terms of market dynamics, there is a high growth due to e-commerce, competitive pressure from Amazon, regional carriers, and startups. In addition, they require continuous investment in automation, AI, and last mile solutions. For freight, their core focus is on shipments over 150 pounds, pallets, and bulk goods. The competitive drivers for freight include cost efficiency, which has pricing based on weight, density, and the class of freight, operational scale, such as having a large fleet of trucks and regional hubs, as well as cyclical demand, which is sensitive to industrial output and economic cycles. The market dynamics for freight is different from parcel as it is more mature and a low growth industry. Freight competes with Old Dominion, XPO, and other LTL specialists while also being less innovation driven and more focused on efficiency and margin control. For conflicting strategies, there are a few things to address. First is growth and stability. Parcel requires heavy investment in speed, automation, and customer experience, while freight emphasizes cost control and steady margins with limited growth. In terms of innovation and efficiency, parcel thrives on innovation while freight avoids high-cost innovations due to small margins and demand that is cyclical. Also, when it comes to brand and resource allocation, FedEx promises speed and reliability. This falls in line with parcel, but is contradictory to freight. Finally, when it comes to strategic fit, parcel has high growth and is an attractive pursuit, while freight is considered a cash cow with low growth and moderate attractiveness, which caused FedEx to spin off FedEx Freight, reducing internal conflict and narrowing their focus. When it comes to organizational design issues, we see that structure follows strategy. Parcel has high growth, is innovation driven, and customer centric. This requires flexible, technology enabled structures to support e commerce, last mile delivery, and global integration. This strategy demands agility and heavy investment in automation, AI, and digital platforms. Freight, on the other hand, has low growth, is efficiency driven, and cyclical. This requires a cost focused, stable structure with an emphasis on an operational scale and margin control. Therefore, FedEx has adopted a strategy that focuses on discipline and conservative capital allocation. There is some structural complexity when it comes to keeping freight. Keeping freight would require different business models, as parcel relies on hub and spoke air-to-ground networks that are optimized for speed, while freight relies on regional trucking terminals that prioritize cost and density. Combining these under one structure would create complexity in coordination. Parcel also demands a heavy investment in tech and automation, while freight requires cost control, which is difficult for a company to accommodate both of these needs at the same time. Parcel and freight also have very different cultures, as parcel is very customer and innovation oriented, while freight leans more into cost efficiency and more of an industrial trucking culture. Finally, there are limitations in synergy between the two. The freight structural needs did not align with the parcel's global network. So why does divestiture resolve design issues? Well, in terms of simplification, spinning off freight reduces structural complexity and allows the corporation to focus on parcel and logistics. When it comes to alignment, FedEx can prioritize growth, innovation, and global integration with the constraints from freight. And finally, with autonomy, freight gains independence to design its own structure specifically for LTL efficiency without pressure to align with the parcel driven framework.
Hi, I'm Edgar, and in this slide, we show some of the pros of the spinoff. One is sharper strategic focus for each company. FedEx can prioritize high growth parcel, e commerce, and global logistics, while Freight concentrates on efficiency, density management, and LTL specific service quality. They could also they could also unlock hidden shareholder value. As a standalone LTL pure play, FedEx Freight can be valued against LTL peers, potentially achieving a higher multiple than when embedded in a diverse portfolio. Also, another pro is tailored capital allocation and investment. Each company can pursue capex, technology, and fleet investments that fit its own risk profile, demand cycles, and return expectations. They could also the another pro is improved managerial accountability and agility. Separate leadership teams and boards enable faster decision making, clearer performance metrics, and stronger incentives aligned to each business's economics. Clearer strategic story for stakeholders. Investors, employees, and customers gain better transparency into the drivers of performance, reducing complexity and improving communication. One of the last pros of the spinoff is retention of selective synergies. Long term com- Long-term commercial agreements and shared technology platforms allow both organizations to preserve high-value synergies while removing structural misfits. And these are some of the risks of the spinoff. Loss or dissolution of operational synergies. Separation may reduce benefits from shared facilities, IT platforms, and coordinated route planning, potentially raising unit costs. Transition and execution risk. Carve out complexities as in systems, contracts, fleets, and labor agreements could disrupt service quality, on time performance, or customer experience during the separation. Higher standalone cost of capital is also a risk. The new freight entity may face a higher cost of debt and equity versus being part of a larger, diversified FedEx balance sheet. Customer confusion and relationship risk. Large shippers used to FedEx as a whole or one FedEx may perceive added complexity in managing separate relationships, pricing structures, and service agreements. There are also cultural and talent challenges. Shifts in brand, governance, and incentives can create uncertainty for employees, leading to morale issues or key talent attrition if not managed well. There's also the risk of exposure to LTL cyclicality. As a pure play LTL carrier, the spinoff will be more exposed to freight volume downturns and industrial demand cycles without the buffer of FedEx's broader portfolio.
All right, let's begin with a quick SWOT analysis to understand the strategic landscape on the strength side. FedEx benefits from a globally recognized brand, a highly advanced logistics network, and strong technology capabilities. FedEx Freight also brings a solid customer base and significant infrastructure. However, the organization faces weaknesses such as complex operational structure and the cost pressure within freight segment. Looking at the opportunities, the spinoff would allow the freight business to focus more directly on its market, foster new partnerships, and customize its services more effectively. Threats include strong competition from dedicated freight carriers, economic uncertainty, and the potential for disruption during the transition. This SWOT framework provides context for the strategic pathway forward. Our high-level recommendation is to proceed with the spinoff, but to maintain strong strategic alliances between FedEx and new freight entity. This approach enables each company to operate independently while continuing to benefit from critical shared capabilities. For example, we recommend preserving technology platforms, certain procurement efficiencies, and network partnerships that support customer reliability. Long-term service level agreements can ensure operational continuity and combine customer solutions. This balanced model allows both companies to innovate, manage costs, and compete more effectively without sacrificing the strengths of their long-standing relationship. Effective governance and stakeholder alignment will be essential to a successful transition. For governance, the new freight company should establish an independent board with expertise in logistics, operations, and supply chain management. Clear performance metrics should be defined upfront, focusing on value creation, operational efficiency, and customer excellence. From a stakeholder perspective, transparent communication is critical. Investor, employees, customers, and regulators must clearly understand the timeline, the transition plan, and how the services remain uninterrupted. By setting expectations early and often, FedEx can reinforce confidence in the long-term benefits of the spinoff. Finally, let's review expected outcomes. For FedEx, separating freight provides opportunity to focus strategically on global logistics, e-commerce, and parcel delivery. This should result in streamlined operations, improved profitability, and a stronger competitive position. For the new freight company, independence brings greater agility, more tailored investment decisions, and the ability to respond quickly to changes in the freight market. Ultimately, both organizations are better positioned to create value, operate with clarity, and pursue growth that aligns with their strengths. This strategic move strengthens FedEx's long-term market leadership while empowering freight to excel as a dedicated industry competitor.
In summary, our analysis of FedEx, spanning its background, corporate strategy, and the structure of its freight division, highlights a company operating in an increasingly complex and competitive logistics environment. Through our review of the external landscape, Porter's 5 forces, and the internal value chain and resource-based capabilities, it becomes clear that FedEx Freight faces strategic constraints that limit its ability to fully align with the broader enterprise strategy. Our assessment of corporate strategy fit, portfolio management, and organizational design issues demonstrates that the freight segment operates with distinct market dynamics, cost structures, and competitive pressures. These differences support a strong rationale for considering a spinoff as a pathway to unlock operational focus, improve strategic agility, and enhance value creation. While the spinoff presents both advantages and risks, the SWOT analysis and our strategic recommendations suggest that a separation could enable FedEx to sharpen its core competencies while allowing FedEx Freight to pursue specialized growth opportunities. The expected outcomes include improved profitability, clear strategic direction, and enhanced stakeholder value of both entities. Ultimately, the proposed course of action positions FedEx to navigate the evolving logistics landscape with greater coherence, competitiveness, and long-term resilience.